Hey guys, Bob Hertzog here again with my favorite loan officer in the world and yours as well, I'm sure. Lizy Hoeffer is taking time out of her day to join us from her car today because she's so busy all the time. And I just wanted to come in for our little quarterly chat with Lizy real quick to talk about mortgage rates and where they are, where they're headed. There's a lot of uncertainty out there, obviously, on what's going on in the mortgage world. And whenever there's uncertainty, then we always turn to Lizy to give her take on what's going on, what to look for, and so forth. So, Lizy, thanks for taking the time today. We all appreciate it, as always.
Yeah, no, it's a total honor. Bob, as you guys know, is like world's best realtor. Knows everything there is to know about real estate in the valley, commercial land, and single family upgrades. I mean, you're a wealth of knowledge, and so it's an honor to be able to provide some insight to your clients.
You betcha. So what's going on with interest rates? Everyone's asking me, are they coming down? We thought they were going to come down there for a while. That I just did a video, gosh, 3 weeks ago. There was an article that came out that had some predictions for next year from Fannie and Freddie and Mortgage Bankers Association and NAR. And they were all kind of talking, hey, a year from now, we feel comfortable that rates will be in the, maybe the mid to high fives. And they stretched up to 6.5, I think was the highest that anyone predicted a year from now. And then all of a sudden, this disaster in the Middle East happened. And obviously that's going to I'm assuming is going to delay our recovery here of interest rates. So just a lot of uncertainty out there. So what do you think's tell me what you think's going on right now?
So interest rates are very impacted by whatever commentary is available for economics. So typically when you hear like of a war or an environmental issue like a hurricane, or you hear of anything that's going to be like a big job losses, anything negative for the economy is actually very positive for bonds and mortgage-backed securities because they're investments that don't have as high of a return as like the stock market, but they're consistent and people know what to expect over a long period of time. So people typically withdraw their money from Wall Street, the stock market at that time, whenever there's volatility, and then put it in things like mortgage-backed securities. So the conflict overseas was actually slightly beneficial in terms of mortgage-backed securities. The reason that the conflict in Ukraine had a negative impact is because they are one of the top suppliers of imports into the United States for a variety of things. And so as a trade partner, that was just going to mean that things got more expensive. And so inflation is the other issue that is really heavily impacting rates. And so the Fed keeps raising the Fed funds rate, which is not mortgage rates, but it is the rate at which banks borrow from the federal government to then loan out. So it does have an impact on mortgages, just not directly. And so that the cost of financing for banks has been more expensive, so that gets passed on. And so unfortunately, the conflict with Ukraine was going to has put pressure on inflation, which ultimately has resulted in high rates. This conflict with the Middle East has so far been beneficial in terms of, creating kind of some insecurity with, the economy. But then shortly thereafter, we had Fed commentary that said, that they still feel inflation is persistent. They also aren't seeing any weakness in the employment market and that there might be additional rate increases, which then, took us over the 8% mark for rates, which is not ideal. This was, though, very anticipated, though, by people in the mortgage industry since the summer. It's a little earlier than we predicted. We predicted November, but this is kind of similar to what happened last year. We saw interest rates go up. We saw them drop at the very beginning of the year because that's when you start seeing unemployment rises, bad weather. You start really getting, you start finding out how holiday sales happen. And that's typically a time of year when we see interest rates go down. And historically, that's what it's been throughout my career.
Got it. So that's interesting. So the conflict in the Middle East, did you notice that it improved rates at all, or did it
It
just keep
did.
them from going
We
up?
did have we did have a slight improvement, but then we lost all of our improvements with Fed commentary this week. Um, we've had some improvement in rates just because it was so dramatic, and that's what always happens. You see the biggest volatility in the days that you get the news, and then after that, investors kind of stable out. High interest rates mean that you know that there's a better return on mortgage-backed securities, so you do just get natural investors wanting to invest in them for the short run. Um, but it's just like with any vehicle, like people want to see like long-term returns. And right now, if you're looking at bond yield as a predictor of that, you'll see that shorter term bonds are actually paying more than longer term bonds because people believe that there is going to be lower interest rates in the future, right? So it would make more sense to have your money in shorter term bonds than it would be in longer bonds.
Okay. Well, that's kind of encouraging news, right? If people are banking on or thinking that rates will improve enough to move their money into shorter term commitments.
Yeah, they have to. So just in general, so everything that is happening right now with mortgage-backed securities is being artificially pressed down, repressed because of Fed intervention, right? So this isn't because of like normal economics. This is like because they're increasing the Fed funds rate. And ultimately, they're trying to lead us in economic slowdown. And so at some point in time, they will have to stimulate the economy. And they'll do that through bringing back down the Fed funds rate, doing things like quantitative easing where they buy mortgage-backed securities. Real estate makes up 30% of the overall GDP for the country. And so
Mm-hmm.
we're like a very large percentage of the overall economics, with all the different verticals that it impacts. And so it would be unrealistic to think that they would just keep rates here indefinitely. And so within like 18 months to 24 months, we should expect to see a significant decline in rates. Right now, most economists are saying June of next year is when we should start seeing it. But really, what you'll want to pay attention to as a consumer is what you hear in terms of any of the headlines regarding inflation going down. So we're following inflation and we want to see increases to unemployment.
Okay. So those are the two key metrics right now we should be paying attention to is the inflation rate going down because mortgage rates will tend to follow that, right?
Mhm.
And what was the other thing again?
And employment. You want to see
Oh,
more
that's right.
jobless claims. So you want to see it. But one thing I will say, because I know everyone tries to time the market,
Mhm.
is that timing the market is very costly. We never know when we're going to hit the bottom until the bottom is passed. And you have your most like leverage in terms of negotiation when you have the least amount of competition. So when interest rates rise 1%, you lose about 1 million buyers. And so right now, the inventory that's available now, you'll get the best deal on in terms of price, concessions, repairs. If you have a contingency, if you have any type of loan for VA or FHA, anything that would in other markets be seemed as like less favorable, you have that advantage now. And so even though it's scary to buy with high interest rates, this is where you're going to get the best deal. And I like the number one question I typically get asked is like when the best time to buy is. And for as an investor, as somebody who's bought their own primary residence 3 to 4 times, I would say it's when you have the least amount of competition for your house.
Absolutely. I mean, when you look at where we are today versus a year or even 2 years ago, that I just had this conversation last night with one of my friends slash past clients that, I mean, you got to jump in at some point. You can't just keep renting forever. And their concern is, okay, once interest rates come down, won't the price of houses come down also? And the answer is no, they won't, unfortunately.
Well,
I
one thing to really know about that is so like last year we did have a reduction in prices and it's not value. So this is the thing that I think people also get wrong. Your house is valued at what the previous sales were in the last 6 months, and then market price dictates the price of homes, and that's what people are willing to pay for your house today. We did see a softening in the market and we did see a pullback about 10%. But then if you look at year over year, right, from where people purchased their properties, they still gained 5% in equity. So
Right.
there really was not like a drop in value. In order to see a drop in value, you have to see a flood of properties enter into the market with lack of demand. Right now, we know that the demand just straight up in population growth and new family creations exceeds the number of houses that are available. So mathematically, we're just not in that position, and not for many, many years. And people have 3% interest rates that they do not want to abandon. So we're not in jeopardy of housing prices going down or any kind of market crash. What we are seeing is like a crash in terms of housing, like inventory. So we
Yeah.
are seeing that.
Right. Yeah, I mean, people are just stuck in their homes, and I mean, who in the heck in their right mind is going to leave a 2.5 or 3% mortgage for an 8% mortgage right now? So, but there are still sellers out there. The sellers, there's one population of sellers out there that I've been talking to lately, and that's the people that are my age, that are empty nesters, that have a ton of equity in their home, and are looking to downsize, where they can take the equity and basically pay cash or put 80% down on their next home. And the other one is the vacation rental market. It's getting killed right now. So the people that own these Airbnbs and VRBOs, we're starting to see those hit the market now. So that is encouraging. What about first-time home buyers right now? I mean, would you say of everybody out there, they're the ones that are getting beat up the worst of everyone, all the buyers?
It's people who, it's the marginal buyer that doesn't make a ton of money that's being impacted right now. And those people just have to be more strategic about buying. So I bought my first home kind of in a similar market. I bought it in 2006, and that I had to buy it with my brother.
Yeah.
And, I knew that I wanted to invest in real estate, so I was willing to take on a partner at that time and do it together. So we've seen, in COVID, we've seen in the Great Recession that families are willing to live together, and this is a great opportunity for generational housing. The other thing to consider, because I know people are reluctant to give up their 2 to 3% rates, but they are also in the highest debt we've seen in over a decade. And so while you might be paying 3% on a mortgage, you're paying 9% on a vehicle, double digits in credit card debt, and your blended rate is way exceeds what you're paying in your mortgage. And so sometimes in order to get ahead, we have to slow down. We have to sell our assets, pay off our debt, and then purchase a new property. And we're wanting to look at the budget holistically, like what is the outgoing cash outlay savings versus what did you just give up in an interest rate? And so I'm seeing this lots and lots. I literally just did this with a client who had about $200,000 in equity. They wanted to put it down on their house, but they weren't getting the payment they wanted. And I said, okay, well, let's look at this here. What if we took $50,000, paid off your vehicle, paid off these 3 credit cards? That's $800 difference to your monthly overall expenses.
Yep.
And then that would make this purchase way more affordable for them. And so we were looking at the budget overall versus just like this 3% rate with all the other debt that's at way higher interest.
Right. For those first-time home buyers out there, especially, is 20% required down, Lizy? 20% down, or are there still some programs out there that allow them to put less down?
There's a ton of programs. So it's anywhere between 3 and 5% typically, and there's some assistance programs that even reduce that figure. So, I mean, if somebody is motivated to purchase, they haven't owned a property in the last 3 years, there are a lot of options that are available to them to make it more affordable.
Got it. The last question I have for you that's been coming up lately is people ask about assumable loans that are out there. And it's my understanding that only VA and FHA could possibly be assumable, correct?
Yeah.
So one thing though, if you're a veteran and you have a VA loan, it's my understanding that if you allow that loan to be assumable, you lose the right to use that again. Is that correct?
Until it's paid off.
Until it's paid off. Right. Okay.
But it's more complicated than that. Veterans have bonus entitlement and things like that. They just might not be able to get 100% financing depending on how much is encumbered. But you don't here's what I don't love about a VA assumable loan is that you never can control somebody else's ability to repay that mortgage.
Sure.
And you would hate to lose your VA eligibility because somebody forecloses.
Right. And you guys do quite a bit in the veterans VA.
Yeah.
Yeah. Okay. Great. Okay. So get your crystal ball out. When are we going to start to see rates drop?
Honestly, I don't know. I mean, I know January is probably a good time when we will see because you get seasonal jobs that are gone. Christmas sales typically haven't been as high as they've anticipated them to be. So that's generally when we start to see an improvement in rates. But it's really hard to say because there's so many different factors at play here. But you guys can tune into my YouTube channel, tune into my Instagram. I do like to give weekly updates, right? Which will probably be more impactful if you guys are shopping for a home.
Right. Okay, cool. All right, Lizy. Well, we'll let you get to your next meeting. Thank you for taking the time to come in and chat with me today. This has been very helpful, and I'm sure all of my folks out there are going to love hearing what you have to say.
Thank you, Bob. I appreciate it.
Okay, have a good one.